You're standing in a kitchen that smells faintly of damp basement and broken dreams. The granite countertops are actually just contact paper, and there's a mysterious brown stain on the ceiling shaped kind of like Ohio. But it's yours. Or it will be. You've got your pre-approval letter, your 3.5% down payment, and a sense of optimism that hasn't been this high since you thought your high school garage band would open for Coachella. You tell the realtor you want to make an offer. She looks at you with the pity normally reserved for three-legged dogs. Before you can even finish your sentence, the house is gone. Sold. All cash. No inspection, no appraisal, 10% over asking. You weren't outbid by a young couple or a guy looking for a fixer-upper. You were outbid by a server rack in a climate-controlled data center in Manhattan. Yes, it's the algorithm landlord. We are currently witnessing the systematic deletion of the American starter home. The white picket fence hasn't been torn down. It's just been digitized, tokenized, and turned into a recurring revenue stream for people who haven't set foot in your zip code since the 90s. This isn't just a hot market. It's a technological coup. The starter home used to be the entry-level drug of the American dream. Now, it's just an undervalued asset class being harvested by institutional investors with more processing power than NASA. The traditional way of buying a house is adorable, in a "I'm using a paper map to find a Starbucks" kind of way. You look at Zillow, call a guy named Mike who wears too much cologne, and drive to an open house where you end up judging people's choice in wallpaper. Institutional investors like Blackstone, Invitation Homes, or American Homes for Rent don't do that. They don't have feelings, and they definitely don't care about all your favorite homes saved on your Pinterest board. They use iBuying algorithms and AI-driven spatial analysis to identify undervalued neighborhoods before the local residents even realize their property taxes are about to spike. These AI models aren't looking for charm or good schools. They're looking for a specific yield. They scan millions of data points: proximity to restaurants, local job growth, the frequency of coming soon signs, and even the sentiment of local Yelp reviews to predict where the next hipster-led gentrification wave is going to hit. When an AI finds a neighborhood with the perfect rent-to-price ratio, it doesn't send a realtor with a plate of cookies. It sends a wire transfer. We're talking about bulk buying on a scale that makes Costco look like a boutique gift shop. In some cities, institutional investors have bought up to 30% of the available single-family homes in a single year. That's not participating in the market. That's buying the market. It's like playing a game of Monopoly where one player starts with all the hotels and everyone else is just hoping to pass go without having to sell a kidney to cover the rent. The economic term for this is financialization. It's the process of turning a basic human necessity, like, a roof, into a complex financial instrument that can be traded on Wall Street. To an investor, your 3-bedroom bungalow isn't a place to raise a family or have an awkward Thanksgiving. It's a single-family rental asset. It's basically a high-yield savings account that you happen to sleep in. Because these firms have access to virtually unlimited cheap capital, often borrowing money at rates you couldn't get if you were the bank's own mother, they can afford to pay more than you. Your 3.5% down payment is competing against a $1 trillion pension fund. It's like trying to win a drag race against a jet engine while riding a unicycle. But why the starter home? Why not go after the McMansions with the 4-car garages and the fountains in the driveway that scream, "I have a midlife crisis"? Because the starter home is the most efficient rental unit ever designed. It's small, it's easy to maintain, and the demand is infinite because, people need a place to live. By cornering the bottom of the market, these firms aren't just buying houses. They're really buying tenant captivity. If you can't buy a starter home, you have to rent one. And who do you rent it from? The same people who outbid you. It's a closed-loop system where the house always wins, literally. You're paying for the privilege of being kept out of the market by the person. You're paying. It's the ultimate financial inception. And don't expect a human touch when the dishwasher explodes and starts recreating the Great Flood in your kitchen. When your landlord is a Delaware-based LLC managed by an algorithm, your customer service experience is essentially a chatbot that tells you no in 12 different languages. These firms have optimized property management to a degree that would make a Victorian factory owner blush. They use dynamic rent algorithms, the same tech Ticketmaster uses to charge you $900 for a concert, to ensure your rent is always at the absolute maximum the local market can bear. If a new coffee shop opens 3 blocks away, the algorithm sees the amenity value increase and bumps your rent by $200 before the espresso machine even warms up. It's surge pricing for your bedroom. This has massive, terrifying implications for personal finance. For the last century, home equity was the primary way the middle class built wealth. It was the forced savings account that funded retirements, college educations, and that ill-advised boat purchase in your 50s. When you move to a usership model for housing, that wealth-building machine is dismantled. Instead of your mortgage payment building your equity, it's building the dividend check for a shareholder in Tokyo or a hedge fund manager in Greenwich. We're moving from a landowner society back to a feudal society, just with better Wi-Fi and more DoorDash options. Instead of lords and serfs, we have strategic asset managers and value-add tenants. Let's talk about the tech stack behind this. It's not just buying low and selling high, it's about PropTech. Companies are now using computer vision to analyze satellite imagery to see which roofs need replacing, so they can lowball owners before they even list the property. They're using predictive analytics to identify homeowners who might be going through a divorce or a job loss, people who are motivated sellers, and hitting them with all-cash, as-is offers before they can even call a realtor. It's predatory math. It's using big data to find the cracks in the human experience and fill them with a 15% ROI. This isn't just about the houses themselves, it's about the securitization of the rent. Wall Street takes thousands of these rental properties, bundles the leases together, and sells them as rental-backed securities. It's exactly like the mortgage-backed securities that caused the 2008 crash. But instead of betting on people paying their mortgages, investors are betting on people being too broke to buy a house. They are literally profiting from the fact that you are stuck. The more people who can't afford to buy, the more valuable these rental-backed securities become. It's a bet against the American dream, and right now, the house is winning. And if you think the government is going to swoop in and save the day, don't hold your breath. Many of these institutional buyers are backed by the same pension funds that government employees rely on for retirement. If the algorithm landlords stop making money, the teachers' and firefighters' pensions take a hit. It's a giant tangled web of damned if you do and rent-burdened if you don't. We've created an economy where we have to choose between young people owning homes and old people being able to retire. It's the ultimate generational prisoner's dilemma. Then there's the AI-driven renovation cycle. These companies have the process down to a science. When they buy a house, they don't do custom renovations. They have a standardized palette. The same gray flooring, the same white cabinets, the same grayish paint. It's the McDonaldization of the suburbs. They can renovate a house in 14 days because they've turned construction into a factory line. A local buyer wants to customize everything, but an institutional buyer just wants it available for rent by the first of the month. Speed is their greatest weapon, and you're still trying to find a contractor who returns phone calls. But wait, it gets techier. We are now seeing the rise of predictive eviction. Algorithms can now predict which tenants are most likely to fall behind on rent based on their spending habits, credit card utilization, and even their social media activity. If the algorithm flags you as a high risk, the company might not renew your lease, or they might preemptively hike your rent to price you out before you become a legal headache. Basically, it's like the movie Minority Report for your apartment. And let's not forget the yield star phenomenon. This is a software used by major landlords to coordinate rent prices. Instead of competing with each other, which would drive prices down, landlords use this centralized data to keep prices high across the board. In any other industry, this would look a lot like a cartel. In real estate tech, it's just called revenue management. It's a digital handshake that ensures no matter which algorithm landlord you choose, the price is the same. The invisible hand of the market has been replaced by a very visible, very expensive software subscription. So, is the dream dead? Is the starter home officially a ghost of Christmas past? Not necessarily, but the rules of the game have been rewritten in a language most of us just don't understand. We're seeing a rise in fractional ownership startups, which ironically are using the same tech to try and give you only a slice of a home since you can't afford the whole one. You don't own the house, you own 5% of the guest bathroom and a sliver of the driveway. It's like stock trading for your living room. It's better than nothing, but it's a far cry from the old "grandpa bought this for a nickel and a handshake" era. There's also a growing movement for corporate transparency laws. People are pushing for legislation that would force these firms to disclose exactly how much of a neighborhood they own and limit how many single-family homes a single entity can hold. Some cities are even trying to ban bulk sales to non-residents. But Wall Street has very expensive lawyers, and algorithms don't get tired of lobbying. They don't even need coffee breaks. Until something shifts, if you're out there house hunting, just remember, you aren't just looking for a home. You're competing in a global high-frequency trading arena. You're up against machines that don't sleep, don't eat, and don't care if the backyard is perfect for a dog. They see a backyard and think, potential ADU for an extra $1,200 a month. And if you find a house that seems like a great deal, just know there's probably an AI in a cold room somewhere that already saw it, analyzed it, and is currently laughing at your cute pre-approval letter. Let's go even deeper into the FinTech debt trap. Because houses are so expensive, we're seeing the emergence of equity-sharing agreements. This is where a company gives you the down payment in exchange for a percentage of your home's future value. It sounds like a lifeline, but it's actually just a way for Wall Street to get a piece of the only thing you have left. They aren't helping you buy a home, they're buying a call option on part of your life. If the house doubles in value, they take half the profit, but if it drops, you're the one underwater. We're also seeing the tokenization of real estate on the blockchain. Now, a hedge fund in Dubai can buy a 0.001% share of a duplex in Cincinnati. Sure, this increases liquidity for investors, but it drives up prices for everyone else too. When the entire world can bid on your neighborhood, you're no longer competing with the guy down the street. You're competing with the entire global capital market. This leads to zombie neighborhoods, areas where the houses are perfectly maintained by corporate crews, but nobody actually knows their neighbors because everyone is on a 12-month lease and looking for a way out. The social capital of a neighborhood, the things that make a place a home, is being liquidated to hit quarterly earnings targets. And finally, we have to talk about the exit strategy. What happens when these firms decide to sell? If a single company owns 10,000 homes in a single city and decides to liquidate their portfolio during a market downturn, they could crash the local economy in a single afternoon. We've given these algorithms the power to create a housing flash crash. It's a level of systemic risk we haven't seen since the subprime days. But this time, the subprime part isn't the borrower. It's the market structure itself. The starter home was more than just four walls and a roof. It was a ticket to the middle class. By turning it into a usership product, we are essentially building a new class of digital serfs who work their entire lives to pay off the interest on someone else's asset. It's a perfect, cold, mathematical system designed to extract maximum value from every square foot of the earth. Next time you see an all-cash quick close sign stapled to a telephone pole, don't see an opportunity, see the digital harvester behind it. The American dream hasn't disappeared. It's just been moved behind a paywall. And unless you've got the processing power to beat the bots, you're just another user in the housing-as-a-service ecosystem. So, welcome to the neighborhood. Your rent is due on the 1st, and don't forget to tip the algorithm.